The hedge fund that almost crashed the global economy, LTCM explained. What if a single hedge fund, backed by Nobel Prize-winning economists and armed with the most sophisticated mathematical models, almost triggered the collapse of the global financial system? Imagine a firm so powerful that its failure could ripple through the world's markets like a shockwave, threatening to take down major banks, pension funds, and everyday investors along with it. This is not a fictional thriller. It's the true story of long-term capital management, or LTCM, a hedge fund that at its peak managed nearly $125 billion in assets, wielding leverage of 25-to-1 on just $4.6 billion in capital. Yet, a financial crisis in Russia in 1998 exposed fatal flaws in their models, bringing them to the brink of disaster and forcing the Federal Reserve to coordinate a massive bailout to prevent what could have been a global economic catastrophe. How did this all happen, and what does it teach us about the fragility of financial markets? Long-term capital management was founded in 1994 by John Meriwether, a former trader at Salomon Brothers, and was soon joined by economists Robert Merton and Myron Scholes, both Nobel laureates renowned for their work on options pricing. Their firm specialized in arbitrage strategies, buying and selling securities whose prices were expected to converge over time, in particular fixed income arbitrage, which focused on bonds and interest rate spreads. At first glance, LTCM's approach seemed brilliant. Use advanced mathematical models, developed by some of the brightest minds in finance, to find tiny price differences in markets overlooked by others, then amplify returns through leverage. Their models were based on assumptions about volatility, correlation, and the normal functioning of markets. Why does this matter? Well, in the mid-90s, hedge funds like LTCM represented a new breed of Wall Street player, blending academic theory with real-world trading. Their successes promised enormous profits and the possibility of stabilizing markets by correcting mispricings. But LTCM's rise also demonstrated the dangers inherent in relying too heavily on models and ignoring rare but catastrophic events, so-called black swans. At its core, LTCM's strategy was about finding what seemed like safe bets where price differences existed between related securities. For instance, a government bond might be temporarily mispriced compared to a corporate bond or a futures contract. By simultaneously buying the undervalued asset and selling the overvalued one, LTCM expected these prices to converge, allowing them to pocket the difference with relatively low risk. The trick was leverage, using borrowed money to multiply the size of trades far beyond their actual capital. Imagine having only $1 but borrowing 25 more to invest. Any small gain on the total $26 results in a much larger percentage return on your own dollar. To manage these risks, LTCM employed complex quantitative models developed by Scholes and Merton, who had won the Nobel Prize for pioneering option pricing theory. Their models used inputs like historical volatility, correlations between assets, and expected returns to estimate the probability of different outcomes and set limits on potential losses. These calculations were highly mathematical, involving stochastic calculus and partial differential equations, which many on Wall Street saw as groundbreaking. However, there was a catch. These models depended on historical data and the assumption that markets would behave within normal ranges. What happened if an improbable event occurred, like a country defaulting on its debt or markets suddenly moving against multiple positions at once? This is where the idea of fat tails, extreme outcomes happening more frequently than predicted, comes into play. LTCM's models notoriously underestimated these tail risks. In 1998, the long-feared shock arrived. Russia defaulted on its government bonds and devalued the ruble amid turmoil in its economy. Suddenly, what LTCM saw as nearly certain convergence didn't happen. Instead, markets became extremely volatile and correlations between asset classes broke down. The very positions LTCM held, which were supposed to offset each other, all moved in the wrong direction simultaneously. Their losses mounted rapidly as counterparty banks and investors lost confidence. This rapid unwinding was dangerous not just for LTCM, but for the entire financial system. At its peak, LTCM's portfolio totaled approximately $125 billion in assets, controlled with only $4.6 billion in capital, a leverage ratio of about 25 to 1. This meant that losses of even a small fraction of the value of their holdings could wipe out their capital and trigger defaults. Because LTCM's counterparties included many of the world's largest banks and financial institutions, its failure posed a systemic risk. A default by LTCM could have forced these firms to absorb massive losses, causing panic and fire sales across global markets. Recognizing the threat, the Federal Reserve Bank of New York stepped in during September 1998 to orchestrate a rescue. They convened 14 major Wall Street banks and investment firms to pool $3.6 billion to recapitalize LTCM and stabilize the situation. This was not a government bailout in the traditional sense. No taxpayer funds were used, but the intervention was crucial in calming markets and preventing contagion. It was a rare, behind-the-scenes moment where regulators, competitors, and counterparties worked together to avoid what at the time could have been unprecedented financial chaos. The LTCM crisis sent shockwaves through the financial world and became a cautionary tale on multiple levels. It highlighted the risks of extreme leverage, especially when combined with flawed risk models that miss rare but devastating events. It also underscored the complexities of financial interconnectedness. No large institution operates in isolation, and the collapse of one player can cascade throughout the system. In the aftermath, many banks reevaluated their risk management practices, and regulators increased scrutiny on hedge funds and their leverage. Moreover, the crisis exposed the limitations of relying solely on quantitative models divorced from economic realities. While LTCM's mathematics were elegant, they failed to capture the full spectrum of human behavior, geopolitical risks, and market psychology. For example, in times of crisis, investors often panic, correlations shift, and what usually behaves as a safe trade can quickly become a fatal bet. In a broader sense, LTCM's near collapse foreshadowed vulnerabilities that would emerge a decade later during the 2008 global financial crisis. The temptation to leverage, the blind spots in risk management, and the systemic risks posed by interconnected institutions were themes that repeated themselves on a much larger scale. So what does this mean for you? While hedge funds like LTCM might seem remote from your daily life, their failures demonstrate how intricately connected the global financial system is, and how risks in one corner can affect the entire economy. If a firm like LTCM's collapse almost caused a worldwide meltdown, consider the safeguards in place now and the importance of transparency and regulation. For individual investors, it's a reminder that high returns often come with hidden risks, and that diversification and understanding leverage are crucial to protecting your wealth. The story of long-term capital management is a cautionary tale about hubris, complexity, and the limits of prediction. It challenges us to think critically about the models we trust, the assumptions behind our investments, and the unforeseen shocks that can disrupt the best-laid plans. In a financial world that constantly evolves, the question remains, how prepared are we for the next black swan? Will the lessons of LTCM guide us, or will history repeat itself once again? The takeaway here is that the collapse of long-term capital management serves as a reminder of the inherent risks in financial markets, particularly when using complex models and high leverage. It teaches us the importance of understanding the interconnectedness of institutions and the consequences of financial failures that can impact the entire economy. As individual investors, we must prioritize diversification, be wary of seeking high returns without fully grasping the risks, and stay vigilant in an ever-changing financial landscape. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Volkswagen Dieselgate, the $30 billion emissions scandal. You will not want to miss it. I will see you there.